Hello guys. So this is our third class from the series of classes that we've been having. So this is not going to be a Zoom session like the other classes that we've had from last week. So I've pre-recorded the video there for you guys, because I understand that some of you are having day classes and so you can't necessarily attend. So I figured that it does not necessarily make that much of a difference, because I also upload these videos on YouTube. So the last week we focused on the introduction to accounting, to see what is it, what's the objective that we are trying to achieve with the accounting. And then we went on to speak about the elements of financial reporting. We spoke about International Accounting Standards Board, which is the body that regulates or that comes up with the different types of accounting standards that we use to record transactions. So the different types of accounting standards, they enforce now, or they tell us the principles that they need to be applied for certain types of transactions and so on. So we spoke about that, and then we also spoke about the elements of financial statements. We discussed about what is income, what is equity, what is an asset, what is a liability. So that's the theory that you need to know. Remember, for that you need to know and be able to define for your level. From there, sesakhuluma ngama-characteristics of our financial statements as well. And then we spoke about the characteristics of our financial statements and the different types of financial statements that the business must produce. And then, so that's what we discussed last week. Of course, we went in detail with all of these things. So if you want to catch up on all these things, please go through our videos that we uploaded last week. Today we are going to continue on the basic accounting principles from last week. And so remember, I told you last week that our objective in accounting, in simple terms, we are trying to transform data in the form of daily transactions. We are trying to transform this data in the form of daily transactions into, we are transforming this data in the form of daily transactions into information that can be useful. So we are transforming data in the form of daily transactions into information that can be useful. To who? To users of financial statements. Users, we spoke about the primary users, to say it's the existing and potential investors, lenders, and other creditors. So today we will start now with what is called an accounting process or an accounting cycle. So for us to be able to convert the data, for us to be able to convert the data in the form of daily accounting transactions into information, and there's a certain accounting process that this data must undergo. So this data comes in the form of daily accounting transactions. That's raw data. These transactions, when they happen, they don't make sense, or they don't have the context in which we need, so that we can use this information to make decisions. So it means that on the process we are going to input daily transactions, and then these daily transactions are recorded in what is called the first book of entry. So this is the first book of entry. It's called a general journal. So this is the first place in which we are going to record the transactions. First book of entry. So this is the first place that we are going to record our transactions. And then from there, after recording the transactions on the general journal, we are going to transfer them on what is called a general ledger. We are going to transfer them on a general ledger. So what does the general journal do, if maybe you wanted to ask the question? So the general journal, we just record the transaction on the day that it happened. So we use what is called accounts, and then we are still going to go into more detail into accounts. So from the general journal, we just record the transactions as they happen, and then from there we take them to a general ledger. So in a general ledger, we take the total or the balances of all the accounts that are the same. So we take the balances of all the transactions that relate to the same account, and then we want to understand how much was paid for that particular type of a transaction, or how much was received for that particular type of an account for a particular month. And so for an example, in a general ledger, maybe we'd record two we received money in the bank. Maybe for an example, we received 100 rand, and then 7 again, maybe you'll be told that you paid someone and maybe 20 rand, which is someone that you were owing. And then maybe 15, you'll be told that 15, maybe you can be told that you received money again from a debtor or a receivable, and maybe let's say he gave you 50 rand. So in a general journal, you would record these transactions as they happen using the right accounts. And then in the general ledger now, you will take all these amounts and then add them together. So 100 plus minus, so it's going to be 100 minus 20 plus 50. So 100 plus 50 is 150. So this is going to give you 180. So this is the total that's going to go into the general ledger. And then in the adjustments, in the pre-adjustment trial balance, so what happens here is that this is where you are going to record these balances that you recorded on the general ledger in the pre-adjustment trial balance. So pre-adjustment means before adjustments, and I'm still going to go into detail with what is an adjustment. So in the pre-adjustment trial balance, these totals that you recorded here, you just display them as a list. Here you use what is called a ledger. We are still going to go into detail as to what is a ledger and how it looks like. And then from there, in the accounting process, we prepare post-adjustment trial balance, which is after the adjustments have been taken into account. And then we further go on to produce a post-adjustment trial balance. Then we do closing entries, and then after closing entries, we do a post-closing trial balance. And then this process, or this accounting process as a whole, is what is going to give us useful financial information. So what am I saying? What I'm saying is that we input financial data in the form of daily transactions that happen, and so that's raw data. So our transactions, when they happen, they don't necessarily tell you much because there's no context for them. And then from there, we organize this info, we record, we organize, we update, we correct this information in this that is called an accounting process. So an accounting process has the general journal, general ledger, pre-adjustment trial balance, the adjustments, post-adjustment trial balance, the closing accounts, post-closing trial balance. From there, after the information has gone through the process, we get the output. The output is what is described on the conceptual framework to say the goal of financial reporting is to provide useful financial information about the reporting entity to the primary users, which is existing and potential investors, lenders, and other creditors. So our goal is to provide useful financial information. That's what the conceptual framework said last week. How do we produce this useful financial information? by taking our adjustments or our transactions, by taking our transactions into the accounting process. Because when we take them into the accounting process, we are converting the data into information. And I hope it makes sense. And I hope it makes sense. So this is basically what the accounting process is about. So you'll be taught during the semester all these steps one by one. You will be taught these steps, and you'll see how all these things look like. And then let's continue. So the other concepts now that we are going to talk about, they include there's something called IFRS and visas, gap or gap principles. So what is IFRS? So IFRS stands for the International Financial Reporting Standards. So these are the international reporting standards that we use in accounting. So these are the principles that we use to record information. Remember, our goal is one of the qualities of the financial information is that it needs to be reliable. The financial information also needs to be consistent. So for this information to be consistent, it means that we should use the same principles irrespective of the business. So for this information to be consistent now, or to be prepared in a consistent manner, is that we need to follow a specific type of guidelines or principles that can help us to do this. And then EACC, and these are generally accepted accounting principles. This was done in high school. So these are just accounting principles that we were using in high school to prepare financial statements. So yeah, this, if they ask it, I don't think so. But they might ask it. Especially, you need to understand what is IFRS, who comes with these accounting standards. Remember, I said the person or the body that's responsible for coming with these accounting standards is called who? Is the ISB, is the one that produces these accounting standards, including the conceptual framework. And then the next concept that we are going to speak about is the transaction. What is a transaction? We spoke about the transaction on the first session. And then what is an adjustment? So a transaction visas an adjustment. A transaction happens, and it happens daily. It happens daily. So it happens between the business. It happens between the business and an outside party. So a transaction happens daily. It happens between the business and an outside party. For an example, when you go and buy bread, for an example, a ShopRite. You go and buy bread. ShopRite is the business. And then who is buying bread is the customer, which is you. You are an outside party. You don't work at ShopRite. You don't have any association with the ShopRite besides being a customer. So a transaction happens between the business and the outside party. A transaction can be between the business and the bank. A transaction can be between the business and the owner. The owner can buy assets on behalf of the business. It's a transaction. So it happens daily. This is what we record now on our books. This is what has to go through the accounting process. And then an adjustment. An adjustment happens at the end of the accounting the accounting period. So when you want to adjust the things, or you want to correct the things that have already been recorded. So an adjustment is internal, so is internal, which means that it happens between the business. So why do we adjust? We adjust so that the information faithfully represents. Remember, we spoke about the faithful representation. So we adjust so that the information that is recorded from the transactions, so that it faithfully represents what transpired in the business during that financial year. So remember, we said that information is faithfully represented if it is free from errors and omissions. So when you are adjusting information, it means that you are trying to fix these errors and omissions that were made, and so that the information faithfully represents, and so that it meets this fundamental characteristic. I hope the difference between an adjustment and the transaction makes sense. And then the next one, in accounting, we use documents called source documents. So source documents, basically, this is just an evidence that the transaction happened, and they serve as evidence that a particular transaction happened, and evidence that a transaction happened. So they serve as evidence that a particular transaction happened. So what does this mean? It means that a source document tells us about the transaction. It tells us about the transaction in terms of the amount, the date, and maybe the parties involved. So we use source documents really when we record information when we record information general weight. So when we want to record information in the first book of entry, or anyway, basically, we need the source documents because they serve as proof or evidence that a particular transaction happened. So for an example, for a cash transaction, you are going to see some things such as check. So a check, you use it when you pay for something. So when you pay, you use a check. Sometimes you use an EFT. They will tell you about the EFT number. So it's when you are paying. So this is for cash transactions. These are for cash transactions. And then sometimes when you make a sale, you can give a receipt to your customer. So this also represents a cash transaction. And then a credit transaction now. So when you sell something on credit, or when you buy something on credit, here we are speaking about an invoice. So this is the source document that is used. And then when you return goods, or when goods are returned to you, here we speak about a debit and credit note. If you want like more explanation based on these concepts, and feel very free to order my study guide, and I elaborate more there. I elaborate more on these concepts, and then I also give examples on the study guide. So the things that I'm teaching you is things that are on the study guide and on the textbook. Then the next concept that we are going to speak about is the reporting period. Remember last week we spoke about the reporting entity. So this week is the reporting period. What is the reporting period? What is it? What is the reporting period basically? So this was number 1. This was number 2. This was number 3. And then this is number 4. So what is the reporting period? What is the reporting period? So a reporting period is a 12-month period. And it's a 12-month period that the business chooses. The 12-month period that the business chooses to measure their results. It needs to be 12 months, which is a year. And of course, big businesses, especially those that are listed on the Johannesburg Securities Exchange, they might choose a lesser period as well. But the most important one is the 12 months. And this 12 months is when, is the period that we choose to measure our financial results as a business. And it can be less, it can be 6 months. Some businesses also prepare maybe quarterly financial statements and all those things. So most businesses, this period is from March to February. And so it's from March the previous year to February the following year. Why most businesses, they prefer this 12-month period there from March the previous year to February the next year? It's because this aligns with the tax period from government. Businesses pay tax, and when they align their financial period and the tax period government, it makes things easy for them in terms of administration. But they can choose any period. They can choose from January to December, or from June to July the next year. They can choose any period as long as it's a 12-month period. So that's a reporting period. So when you're preparing financial statements, and this is the most important information. That's the first thing that you need to underline or highlight. Okay, the period is from this to that, so that you know the years or the months that you are working with, or the 12-month period that you are working with, so that you can be able to perform the necessary adjustments, or so that you can be able to record information correctly according to the accrual basis of accounting. And I'm still going to go into accrual basis of accounting as well. And then the next concept that I'm going to speak about is the going concern principle. Going concern principle. So this is one of the most important principles as well, going concern principle. So a going concern principle states that, or says that, our financial statements, they are prepared based on the assumption, or must be prepared based on the assumption that the business is going to continue to operate, based on the assumption that the business will continue to operate in the foreseeable future. So think about this thing, guys. Financial statements are prepared. Is the assumption that our financial statements are prepared based on the assumption that the business is going to continue to operate in the foreseeable future. So think about that statement. So let's say you run a small spaza shop. Let's say it's a mobile spaza shop, or is a 2-series spaza shop. A 2-series spaza shop is that spaza shop whereby you are selling on campus, but you are not stationed at one place. You are selling from your bag, for an example. Wherever you are selling. So that's a 2-series spaza shop. So, or let's say you are running a proper spaza shop. Let's do playing. Let's say you are running a proper spaza shop. So if in this spaza shop, you know that you are going to come back tomorrow, you are going to continue selling, you are going to come back. Let's say today you are closing, and tomorrow you are going to come back and continue selling. The balances or the trading stock that you had for today, you are going to leave it today, and then so that you open with it tomorrow. And the furniture, the equipment that you have today, you are going to keep it in the business because you're going to continue operating. But think about a situation where you decide, no, I'm closing down. Let's say you find a job, and this job is really nice, and you have to close down this other shop. What do you think is going to happen to your trading stock and your furniture? You're going to sell it. So what point am I driving here? I'm trying to say to you, when the business is preparing financial statements on a going concern principle, we are assuming that it's still going to continue operating in the near future, which is the next 12 months, for an example. So the balances of trading stock, the assets that the business has, they are going to be recorded on the balance sheet to show that, okay, the business is still going to continue to operate. If the directors know for some reason that the business is going to be liquidated, a different set or different principles are used to prepare these financial statements. So what you need to understand about the going concern is that is a definition to say, is the assumption that, or is the assumption that the business will continue to operate in the foreseeable future. So when you prepare more financial statements, you have to assume that the business is going to continue to operate in the near future. I also elaborate more on this concept on the study guide in a simple manner, of course. It's very simple and straightforward. I also give examples. I also expand now. We talk what happens when the business prepares financial statements. No, what happens when the business is about to close down. How do they prepare the financial statements? So if you are really interested in knowing more about this content, please feel free to text me about the study guide. So the next principle that we are going to speak about is the historical cost principle. So the historical cost principle is that assets of the business should be recorded at their historical cost price. So it means that they should be recorded at their price at which they were bought, and then not the future value or the future price of the asset. So if you buy, for an example, land today for 1 million, and maybe the people who do valuations, they tell you that this land after 5 years is going to be worth maybe 1.5 million. The amount that you record is the historical amount, which is the amount at which the land was bought, which is 1 million. And so that's what basically the historical cost principle means. Any asset that you buy, trading stock, vehicles, equipment, you always record them at their historical cost. Remember, when you record an asset at its historical cost, if VAT is included on the transaction, if VAT is included, you have to first remove VAT. If VAT is the value added tax, you have to first remove VAT if VAT is included on the transaction. And then the last concept that we are going to speak about, the last one, is the business entity rule. So this is the business entity rule. First semester, you are dealing with a sole trader. What is a sole trader? We spoke about it last week. A sole trader is a business that is owned and controlled by one person. So only one person is responsible for this business. It's owned by one person. So what the business entity rule says is that the financial statements, financial information, and the financial information of the business should be kept separate. Should be separate from that of the should be separate from that of the owner. So the financial affairs, you can say the financial affairs, yeah, this is the right term. So the financial affairs of the business should be separate from that of the owner. One of the things that's making small businesses to not expand, especially the ones from EACC, is that most of them, the owners, they use the business to fund their lifestyle. And as a result, the business doesn't grow because the financial statements of the financial affairs of the business, the owner is in the financial affairs of the business, the owner is too much involved there, and he takes a lot of money from the business and all those things. And so when the financial affairs of the business and that of the owner are separate, the owner can be able to open a separate bank account for the business, and then everything that relates to the business is going to belong to the business, and then everything that belongs to the owner is going to belong to the owner. So you should make the distinction between financial affairs of the business and the ones of the owner. So that's what the business entity rule says. And so if, for an example, the owner takes inventory from the business, those are going to be considered as drawings. And then if the owner invests money into the business, that's going to be considered as capital. And there needs to be a separation between the financial affairs of the business and those ones of the owner. So this is where I'm going to stop today. These are just the basic terms, guys, that you need to understand and know their meaning, because these are the principles that we'll be applying going forward. And in terms of historical cost, we'll be applying them a lot. Whenever we buy an asset, we'll record the historical cost. And going concern principle is mostly applicable when you are preparing our financial statements. And then, yeah, that's it for today, guys. I don't want to make this video to be too long. I don't want to make it to be too long. So please go through these concepts, check your textbook as well, and then check your notes as well from a class, and then combine all the information. If you still have questions, please feel free to give me a text, and then I'll try to answer you. But anything more than this, thank you very much, guys. I'll see you on the next video. On the next video, we're going to go deep into the accounting equation and then start recording transactions. So this is where things are going to start being interesting. Thank you very much, guys.